I've just bought 200 euros worth of Aker VP, this Norwegian all stock, which in my opinion, it's a hidden gem. Nevertheless, my position is not big at all. I'm just gonna let you see my portfolio right there. This is my portfolio, this is my dad's portfolio. And between both of us, this doesn't make much more than 3.6% of my portfolio. So a really small position worth 2000 Norwegian krone. I already told you in last video that this was probably my favorite stock because Exxon and Chevron, yeah, they are the big players. Everyone wants to own these two stocks, but their dividend yield it's not attractive at all right now. And even if you pay a lesser amount of withholding tax in the American state, it just doesn't compensate. I rather pay higher taxes but get much more money back. Right now, Aker BP is around a 10% dividend yield, so the yield has improved a little bit. It's a little bit more attractive. And before we go into the stock analysis, I want to share with you some beautiful Warren Buffett analogy that I think you'll love. Turn for the GOAT himself.
Might decide that for $70 an acre, you would want to, if you decided you wanted a 7% return, you'd pay $1,000 an acre. Now, if farmland is selling for 900, you're going to have a buy signal. And if it's selling for 1200, you're going to look at something else. That's what we do in businesses.
So, as you can see, Warren Buffett makes everything so simple. Translating this Warren Buffett knowledge into the Aker VP stock we've just bought, we would say that they are paying around 26 krona of dividend per year. And if I want to achieve a 10% return, I would just divide by 0.1 and we would obtain that the fair price to pay for a 10% return for this old company would be 260 krona. For the people that didn't watch the last video, the main reason I chose Aker VP is the low cost production per barrel. It was around $6 in 2023 and 2024 and during their last quarter 7.3. The stock has crashed today a 5%, but to me this is a great opportunity to keep buying it since they even made money in 2020 while all the other old stocks lost a lot of money. You can go check it out in the last video. The thing I like the most about Aker is the fact that they have a really strong balance sheet, around 4 billion of cash and cash equivalents, while their debt is only 8 billion. This is a much better position than Exxon's or Chevron's. So once we've highlighted this, I'm expecting a 5% growth in their free cash flow for the next 5 years and a 5% too afterwards. This is pretty conservative, but it's in line with their dividend growth. So as long as they are able to grow their cash flow, the bare minimum, we're good. That dividend is safe and it will be growing. The growth in perpetuity is a 2.5%, while the discount rate, as we've discussed before, it's a 10% because I want to achieve better than market returns, so it doesn't make sense to use an 8%. The sum of all the discounted cash flows comes to 21 billion, then we sum the cash, we subtract the debt, and we get an equity value of 17 billion. Then we divide by the shares outstanding and we get to a price per share of $28, which would be equal to around 290 Norwegian krone. And just for some context, look at how much better Aker BP is compared to Exxon and Chevron. Their growth margin is around a 66%, while Exxon's and Chevron, it's around a 20%. The operating margin, then again, it's around 60% for Aker, while Exxon and Chevron struggle to get a 10%. And in the profit margin column, we see the same trend. We can even use a dividend discount model, but it's just not my favorite model because I feel it's really sensitive to the output. For example, if we put here a 5%, which was the expected growth rate of the dividend from the company, we would get that the fair price is around $50 a share. To be honest, that's a little bit pricey for me. Right now, it feels like Aker VP is trading around a fair value. $50, it's way too expensive. The dividend yield would go to 5%, which is pretty bad. But if we look at the historical numbers, we can see that their average dividend yield for the past 10 years has indeed been 5%. I just removed the last two numbers, which were skewing a little bit our calculation. It was actually around 6%, which would mean that if the stock was right now trading at a 6% dividend yield, the share price would appreciate to $36 a share. Right now, we can buy it in the market, in the stock market, with a 61% higher dividend yield, which I feel it's a great deal, as I said before. I don't think the historical P ratio versus the current P ratio it's a good way to value all stocks. When it comes to the market versus book value, we can see that their book value per share has grown a lot, while their share price hasn't really reflected this growth in equity. So this also gives us a little bit of a margin of safety. It makes me feel more comfortable owning the stock, knowing that the underlying business is actually growing and the stock market hasn't really reacted yet or doesn't really know how this stock. We're not going to project the growth for the earnings because I feel it's more of a dividend stock. It doesn't really make a lot of sense for us to do this, but we look at their moat. The reputation is there, economies of scale, obviously they do have them, much better than the ones from Exxon or Chevron. They are able to produce at a much lower cost, so this is just great for them, and I feel this is their biggest moat, right, with being a low-cost provider. They do have the government protection. I mean, obviously this industry is super important for Norway. The high switching cost will depend on the geopolitical situation. The network effect, not really, and strong brand name, I wouldn't say so. They are only operating as a upstream company, which that minimizes a little bit their visibility to the public. Would it be a buy according to Buffett? Well, let's take a look at this. Their ROCE it's above 14%, while their ROIC it's much below 14%. Nevertheless, they do have a high ROE, while their net income is beautifully growing. The dividends are indeed growing a lot. Their free cash flow payout ratio is indeed good. This number is misleading. In terms of valuation, their current free cash flow to EV yield or their owner's yield it's not above 5%, but the average for the five last years is indeed above this 5%. It may seem as not the greatest time to buy this stock, but during their past 5 years, they've profited a lot from the geopolitical situation in the world. I do not expect them to be able to return to 4 billion of free cash flow per year, but with the current free cash flow, it still is an attractive valuation. As I said before, their debt is in an amazing situation, and finally, they've been growing to a faster rate than inflation. According to my projections, the fair price per share would be around $25. And when it comes to historical averages, we can say that the stock is currently trading below historical means. All in all, we come to an intrinsic fair value of $28 per share. If we want a margin of safety of 10%, we're in a great position to buy right now. If we want a 20%, we would have to wait a little bit more. I do not have a crystal ball to predict the future, nor to know if tomorrow the barrel is going to go to $100 or to $50. But one thing that I do know is that the stock is attractively priced for me for the 10% return I want to achieve yearly. And furthermore, Warren Buffett and Charlie Munger, which are much better experts than I will ever be, to be honest, have been saying for a lot of years that they think that the oil will become more and more precious. You can make your own conclusions from this. I just want to say that I've recently released my research paper, and with the support of Dr. Filippo Ippolito, we found out that the S&P 500 is mainly ETF driven. That's one of the main reasons the stock market keeps going up. I feel it's a really interesting research, so if you want to take a look, I'll leave it around here. As always, hope you have an amazing day, and I'll see you in la próxima.